Robinhood stock ended Wednesday's trade just slightly lower, closing at $100.82, down by 2 cents on the session. At first glance, that might look like a quiet day. But beneath the surface, it was anything but uneventful. At one point, Hood briefly dipped back below the psychologically important $100 level, hitting an intraday low of $99.41. That bounce back to close above 100 is a relief for now, but it highlights just how critical that support level has become. The question traders and long-term investors alike are asking is, will that line hold, or are we on the verge of a more meaningful breakdown? Today, let's unpack what's going on with Robinhood stock, what the risks and opportunities look like, and where cautious optimism still fits into the story. Let's begin with Wednesday's tape action. Robinhood opened the day at about $101.50, dipped quickly in early trading, and at its worst was flirting with the $99 mark. Buyers stepped in, pushing the price back into triple digits, and by the close, the stock managed to grind back to just above 100. That tells us two things. First, there are still plenty of investors willing to defend the stock at that level. Second, the support is real, but fragile. Support levels are important in any stock, but in a name like Robinhood, which has already rallied more than 170% year-to-date, they take on even more significance. Momentum-driven stocks tend to attract technical traders, and when those psychological floors are broken, selling can accelerate quickly. That's why watching the $100 mark is so important right now. So what's driving the pressure? The first factor is technical digestion. Robinhood has been on a remarkable run in 2025, climbing from lows near $30 to highs above $120. Pullbacks are natural after that kind of move. The stock is consolidating gains, and a retest of support levels is part of that process. Bulls will argue that as long as Hood holds 100, the broader uptrend remains intact. The second factor is lingering disappointment around the S&P 500 exclusion. Just a week ago, many had speculated that Robinhood would finally be added to the index. The company meets the size, profitability, and liquidity criteria. Yet once again, it was passed over, with Interactive Brokers getting the nod instead. That hurt sentiment, because inclusion would have brought in billions in passive inflows from index funds. Missing out doesn't change fundamentals, but it does remove a near-term catalyst. That overhang continues to weigh on the stock. Third, crypto volumes remain a watch point. Robinhood has leaned heavily into crypto trading as a growth driver, and while Q2 results showed year-over-year strength, sequential numbers hint at cooling activity. Given how closely Robinhood stock has been trading in sympathy with Bitcoin and Ethereum, any softness in digital assets tends to ripple through Hood's performance. The volatility in crypto this week has only amplified caution. Finally, analyst sentiment is mixed. Several high-profile firms, Mizuho, Citigroup, Barclays, JMP, Piper Sandler, and Cantor Fitzgerald, maintain bullish buy ratings, with price targets ranging from $118 to $130. But consensus sits lower, around $97.50, suggesting downside from current levels if growth slows. That split creates uncertainty, and it shows up in choppy trading action. So where does cautious optimism come in? First, despite recent volatility, Robinhood has proven it can hold its ground. Wednesday's bounce from 99 back above 100 wasn't just luck, it was buying interest, evidence that the support level is respected. Until that breaks decisively, the bull case remains alive. Second, the long-term fundamentals continue to strengthen. In Q2, Robinhood reported 42 cents in earnings per share and nearly $989 million in revenue, up 45% year-over-year. Funded accounts now stand at 26.5 million, with $279 billion in assets under custody. Average revenue per user is climbing, now at $151. These are not the metrics of a company in decline. Third, Robinhood's roadmap is ambitious. The Bitstamp acquisition expands its international crypto presence. Tokenized stocks and ETFs in Europe represent a first step toward 24/7 global trading. Staking and futures products diversify revenue beyond simple trading commissions or interest income. Even if near-term crypto volumes cool, these initiatives lay the groundwork for longer-term growth. Fourth, the macro backdrop could eventually turn supportive. While lower interest rates would reduce net interest income, one of Robinhood's recent profit centers, they would likely increase risk appetite and trading volumes. Historically, rate-cutting cycles have boosted retail engagement. If the Federal Reserve follows through with cuts later this year, Robinhood could be a prime beneficiary. Now, it's important to also highlight the risks. If the $100 level fails decisively, technical selling could accelerate, pushing HUD back toward the mid-90s or even lower. Crypto remains volatile, and regulatory questions around tokenization and digital assets linger. Competition in the brokerage and fintech space is fierce, with giants like Schwab and Interactive Brokers always looming. And while S&P 500 inclusion is likely eventually, its absence today removes a potential short-term catalyst. So what should investors watch next? Number 1. The $100 line itself. As long as Robinhood can defend that level, the uptrend is intact. A sustained break below would change the tone and possibly trigger more downside. Number 2. Crypto markets. If Bitcoin and Ethereum stabilize or rally, expect Robinhood to follow suit. If they falter, pressure could intensify. Number 3. Fed commentary. Rate cut expectations are shifting, and dovish signals could stoke risk appetite, while hawkish ones might pressure growth stocks like Robinhood. Number 4. Analyst moves. A fresh upgrade, especially with a target above 120, could spark renewed momentum. Conversely, downgrades could weigh on sentiment. And number 5. News around product innovation. Updates on Bitstamp integration, tokenization, or global expansion could reignite enthusiasm. So here's the bottom line. Wednesday's close at $100.82 looks modest on paper, but it was a test of nerves. The stock dipped below 100 intraday, then rebounded. Support is holding, but it's under pressure. Investors should treat 100 as a line in the sand. If it holds, the story remains bullish. If it breaks, brace for turbulence. But looking longer term, Robinhood is still a company in transformation. It's building a platform that sits at the intersection of fintech and crypto, with ambitions to reshape how retail investors engage with markets. That story isn't undone by a missed S&P inclusion, a week of choppy trading, or a momentary dip below a round number. For traders, the focus is on short-term levels. For long-term investors, the focus should be on the company's growth trajectory, and by that measure, Robinhood remains on track. Volatility is part of the package with this stock. It always has been, and it likely always will be. But volatility creates both risk and opportunity. Right now, the opportunity is that dips toward 100 could represent accumulation zones for those who believe in the bigger picture. So as we head into the next few sessions, keep your eyes on 100, watch the crypto charts, and listen for Fed signals. Robinhood has had a rough patch, but the broader narrative of growth, innovation, and transformation remains intact. And that's why, even after another volatile week, cautious optimism is still warranted.